Hey everyone, Eric here. Thanks for tuning in. There is so much financial information on the internet that could be pretty overwhelming to try and digest by yourself. I distinctly remember graduating from high school and wanting to learn how to invest my hard-earned cash that I saved from all my serving jobs. However, as soon as I Google searched how to invest your money, I got a million different articles, opinions, and strategies on how to do so correctly. The amount of information was straight up intimidating and it kind of turned me off to the idea of investing. I didn't want the same thing to happen to you guys, so I decided to make a video about it. Today, I wanted to go over each of the possible investing strategies that you can start using to build your multi-million dollar portfolios. I guarantee you that if you watch until the end of this video, you'll have all the information that you'll need in order to start that portfolio, and I'll answer any questions that you have regarding 401ks, IRAs, index funds, ETFs, mutual funds, money market accounts, certificates of deposit, peer-to-peer lending, real estate investment trusts, and last but not least, high-yield savings accounts. I know we have a lot to cover, so let's go ahead and get started. This is Investing 101. But first, make sure to subscribe to my YouTube channel if you haven't already to join the Millipreneur community. If any of the information that I share with you helps in any way, shape, or form, make sure to demolish that like button for me. It really helps me out. Also, make sure to turn on notifications so that you're alerted every single time that I post a new video. And last but not least, feel free to comment below what investing strategy that you're going to pursue during the pandemic. Having said that, let's get started. The first place that you've probably been told to invest your money is the traditional 401k. Although the 401k is as mainstream as an investment strategy gets, it was actually almost created by accident. The 401k was first proposed by Congress in the Revenue Act of 1978, which actually had a section that was called the 401k. This provision allowed employees to avoid being taxed on deferred compensation. The easiest way to explain this is by thinking about the checks that you receive from your employer. The money that you earn on a monthly basis has already been taxed before you receive it. However, if you elect to invest a portion of your earnings into a 401k, you will actually have not gotten taxed on that money. You won't be taxed until you access that money past the age of 59 and a half. Since Uncle Sam has not yet taken its share of your earnings when you invest in a 401k, there's actually more money in the account itself. This allows your money to grow faster due to the fact that you are getting returns on a higher dollar amount. For example, let's say that you have $10,000 invested in your 401k. That money has not yet been taxed by the government. However, if you decide to invest in a Roth IRA instead, you would be doing so with post-tax dollars, meaning the government has already pulled taxes from your actual earnings. Assuming that you're in a 22% tax bracket, you will only have $7,800 as opposed to the $10,000 that you could have invested with pre-tax dollars. I hope this makes sense, but just understand that pre-tax dollars means that you haven't been taxed by the government yet, and post-tax dollars means that you have. And just a quick side note, as of 2020, you are able to invest $19,500 into your 401k if you are under the age of 50 and $26,000 if you are over the age of 50. In addition, you aren't able to actually access those funds until after the age of 59 and a half without penalty, so make sure to understand that this is a long-term strategy. Also, it is very common for your employer to match a certain percentage of your salary to invest into your 401k. The most common match provided by employers is 50% of what you put into the account up to 6% of your salary. In other words, let's say that you make $100,000 per year to keep things simple and you invest $6,000 into your 401k. Your employer would actually invest $3,000 on your behalf since $3,000 is 50% of $6,000, but they won't put a penny over that. So instead of just having $6,000 invested into your account, you'd actually have $9,000. So it's pretty much free money. Also, every single dollar that you invest into a 401k is considered a tax write-off, so make sure to seriously consider this investment strategy when you get into the workforce. If you'd like me to make an entire video on what tax write-offs entail, then feel free to comment below and like the video. Now you may be saying to yourself, okay great, I know what a 401k is, but what exactly am I investing in? When you invest in a 401k, what you are really investing in are mutual funds. Mutual funds are professionally managed investment funds that pull together millions of dollars from a variety of different investors to invest in the stock market. Each mutual fund manager has a different approach or a different strategy when investing in these mutual funds, so make sure to do your research prior to actually investing in them. You're going to want to check out what types of stocks that money manager is going to be purchasing, as well as the management fees that are associated with the account. The typical management fee for these actively managed accounts is between 0.5% to 1%. The next investment strategy that I'm going to cover is the traditional IRA due to its similarities with the 401k. However, there are a few distinguishers. The first difference is that traditional IRAs are not employer sponsored. You open this account on your own, so there is no employer match. The next difference is that you cannot invest more than $6,000 on an annual basis if you are under the age of 50 and no more than $7,000 if you are over the age of 50. These are the same contribution limits as the Roth IRA, which I'm going to cover next. The last difference is that you have many more options when investing in a traditional IRA versus in a 401k. And just a quick side note, if you had started a 401k with your old company but are no longer employed there, it would actually be considered an IRA at that point. The account is no longer employer sponsored, so it can't be a 401k if you're catching my drift. Alright, next up we've got the Roth IRA, which I'm sure you've heard of by now. Like a traditional IRA, you are able to invest up to $6,000 per year if you are under the age of 50 and $7,000 per year if you are over the age of 50. The best part about this investment strategy is both your principal as well as your interest will grow tax-free. To illustrate the power of compound interest, if you started investing in a Roth IRA at the age of 18 and invest $500 per month until the age of 65, you will have accumulated over $2 million in your retirement account. Now, if you are not 18 years old, don't worry, this investment strategy can absolutely still work for you. Just understand that the longer that you wait, the less money that you'll have come retirement age. For example, let's say you started investing in a Roth at the age of 25 and still invest that same $500 per month. You will have accumulated still over $1 million. Keep in mind that once you have withdrawn money from your account, you're still only able to invest up to $6,000 annually. There are some exceptions to the early withdrawal penalties, such as first-time home buyers, maybe qualified student expenses, and last but not least, if you were to pass away, God forbid. However, as a general rule of thumb, I would advise against pulling out your earnings from your Roth IRA. And I want to make this clear, I don't recommend pulling any money out of your Roth IRA unless it's in an emergency situation. This is why it's important to have an emergency fund prior to starting your Roth IRA. The Roth IRA should be used to accumulate long-term wealth, so if you're going to need that money in the short term, then you probably are better off just putting it in a high-yield savings account. And please note, if you make more than $120,000 per year, you're actually not able to invest in a Roth IRA without doing a backdoor Roth IRA conversion. I'm not going to cover that in this video since I imagine that most of you make less than $120,000, no offense. But if you do make more than $120,000 per year, go ahead and use the almighty search engine Google or Bing or whatever your kids use nowadays. Now, there are a ton of companies that you can begin investing in a Roth IRA with, but I'm going to be covering the two that I used personally, which are Betterment and Vanguard. Now, if the thought of learning how to invest your money properly or just learning about finance in general makes you feel nauseous, then I would probably recommend investing with Betterment. Betterment utilizes robo-advisors that automatically tailor your portfolio based on your age and your tolerance for risk. They charge 0.25% or $25 for every $1,000 that you invest into the account. When you decide to invest in a Betterment account, what you're really doing is making sure that your investments are entirely passive. You don't have to worry about it. You just set it and you forget it. Now, the next question you might be asking is, where exactly is my money being invested in Betterment? Now, I'm not going to bore you with what each of these holdings means, but just understand that the majority of them mean that you are investing in the stock market as a whole as opposed to investing in an individual stock like Apple or Amazon. If you are under the age of 40, it is likely that you're going to have 90% of your money invested in stocks while 10% are invested in bonds. And you'll also notice that Betterment actually utilizes a lot of Vanguard's index funds, but don't worry, we're going to cover Vanguard shortly. As you grow older, the robo-advisors will automatically tailor your portfolio to reflect a larger bond ownership as opposed to stocks, considering that bonds are typically seen as less risky. You don't want to be taking on a lot of risk when you're older, since the money that you've accumulated, ideally you want to keep and not lose at that point. Once you open your account with Betterment, you can just set up automated payments and pretty much forget about the account itself since your money is well diversified. Alright, so although Betterment is a fantastic place to start investing your money if you have no desire to actually pick and choose where your money is invested, I think that Vanguard is actually the better option if you do. Vanguard is a pioneer in the investing world and was the first to introduce low-cost index funds to ordinary consumers. Their philosophy revolutionized the way that investors looked at investing in the market, from trying to beat the market's performance to simply trying to match it. Vanguard's fees for its S&P 500 index, or VFIAX, is very, very low. It's only 0.04%, which is only $4 for every $1,000 that you invest into the account. In addition, you are able to invest in a variety of different index funds and pick and choose what your strategy will look like. If you're willing to just put in a little bit of research to figure out what index funds to invest in on your own, then I think that it will save you a lot of money in the long run versus just investing in a robo-advisor. However, please note that you will need at least $3,000 to invest in an index fund, and if you don't have that minimum, you can always just invest in an ETF alternative. Vanguard's S&P 500 ETF is hovering around $300 at the moment, so if you have that, then go ahead and buy it. So you still may be confused as to what an ETF is versus an index fund, so I'm going to go ahead and paint the differences and the similarities right now. And shout out to Stephanie for actually asking this question on my Instagram. So first of all, index funds are actually considered mutual funds. I know this probably sounds confusing, but their aim is to track an index. Some examples of indexes are the S&P 500, which tracks the top 500 companies in the United States, as well as the Dow Jones Industrial Average that tracks the top 30. As an index fund investor, you are essentially going along for the index's ride. In other words, when the index is performing well, so is your portfolio, and if it's not performing so well, neither is your portfolio. Now, an index ETF is also very similar because its goal is to mirror the performance of a benchmark index. Index funds and ETFs are also both passively managed, so they have some of the lowest rates on the market. Although both investment vehicles have the same goal, they actually take different paths in order to achieve that goal. So now that we've gone through the similarities between ETFs and index funds, here are some of the differences. First, ETFs trade throughout the entire day, while index funds only trade once during market close. The next differentiator is that you cannot automatically invest in an ETF like you can in an index fund. With an index fund account, you are able to set up automated payments and never forget to invest in it. I like this feature that index funds offer because I don't check my Roth IRA more than once or twice per month. I would rather just set that money up, set up the payments, and forget about it. Plus, if you have a Roth IRA composed of ETFs, you have the ability to buy and sell them whenever you want, which I don't recommend doing, especially if you're investing for the long run in a Roth IRA. The last thing you're going to want to do as a novice investor is try and time the market, so just go ahead and set up an account with index funds if you have the means and just invest and automate the payments. The last difference is that index funds often have higher minimums than ETFs. I covered this point earlier in the video, but the minimum amount of money that you can have to invest in an index fund is $3,000, while if you just invest in the S&P 500 ETF, VOO, with Vanguard, it's about $300. Now, the more recent investment strategy that employers have started to offer is the Roth 401k, which I've gotten a couple questions about. Roth 401ks allow you to invest up to $19,500 post-tax dollars per year. However, Roth 401ks are employer sponsored, so you have less options to invest in. If your employer offers a match on this account, then it will actually go into the traditional 401k portion. This means that the contributions that your employer are making into your account will be going into a pre-tax portion, and you will be taxed on those come retirement age. Here's a picture that you can screenshot for your convenience that does a pretty good job to sum it up. Alright, so now that we're done with 401ks and IRAs, let's go ahead and give the bank some love and talk about CDs. No, not compact discs. What do you think this is, the 90s? I'm referring to certificates of deposit. Okay, you're gonna have to go. Certificates of deposit are generally offered by banks or by credit unions that basically tell you to put a lump sum of money into their accounts for a certain period of time, and they're gonna pay you interest on that. The length of time in which your money will be invested in that CD will vary from 6 months all the way up to 10 years. Considering that I haven't found a single CD that pays you more than 1.25% in interest on a 2-year certificate of deposit, I would just recommend shying away from this investment strategy. High yield savings accounts will generally pay you 1% just for having the money in that particular account, so I would just recommend putting your money in one of those as opposed to locking your money up for a certain period of time. It really just doesn't make sense to invest in a CD because if you try and access that money, you're going to hit with a huge fine. Now, before I cover high yield savings accounts, let's first go over money market accounts and why I would recommend avoiding those as well. A money market account is essentially just a savings account, but with some checking features. Traditionally, when you open a money market account, you will receive a few checks or a debit card and are allowed a few transactions per month. These accounts used to boast high interest rates, but since the emergence of high yield savings accounts, they are just simply no longer competitive. The average interest rate on a money market account is 0.18%, so I would just avoid these accounts. And finally, now we're going to be talking about the high yield savings accounts. These are like your traditional savings accounts, but on steroids. For example, if you currently have a traditional savings account open, you are likely being paid next to nothing for having that money in the account. The average interest rate offered by a traditional brick and mortar bank is about 0.1%. The reason why I like high yield savings accounts so much is because they offer up to 10 times the amount that your traditional bank will. I currently use Capital One's 360 savings account that is paying me 1% annually on whatever amount I have in that particular account. The interest rates paid out by Capital One were actually over 2% prior to the Fed lowering interest rates, but that's a topic for another video. Here's a list of the best high yield savings accounts for the month of July, and feel free to take a screenshot. Now, I haven't personally invested in any of these banks, but I would recommend doing your own research prior to putting money into any of these savings accounts. Now, you may notice that Capital One's savings account is not on this list, but the reason that I haven't moved my money is one, I'm getting $500 for having the money in that account for more than 3 months. It was a promotional offer. And two, the interest rates that are paid are about 1%, so it's not that big of a difference. And sorry to burst your bubble, but you will have to pay taxes on any interest that you accumulate within these accounts. Damn it, Sam. Next on the list, we have peer-to-peer lending. If you have ever taken a loan from a bank, you've had to pay interest on it. Peer-to-peer lending is very similar. The only difference is that instead of borrowing from large banks and corporations, you're borrowing it from investors like myself. On the flip side, if you are a lender and you elect to lend to riskier borrowers, then you'll actually potentially have a larger payout. Now, just please be aware that the more risk that you take on, the higher the likelihood that the borrower will not pay you back because they have lower credit scores, so they're generally seen as less responsible borrowers. Companies like Lending Club will allow you to allocate your risk as you see fit, but generally speaking, you should see a return of between 7 to 10% annually. And last but not least, we've got real estate investment trusts, or REITs. I think I'm pronouncing that right. No pun intended. Think of a REIT as an investment in a variety of large multifamily units. The alternative would be going out and buying an investment property yourself. It is similar to investing in the S&P 500 in the sense that you're investing in multiple units as opposed to just buying one house and putting your eggs in that basket. REITs take cash from numerous investors and put it into a large pool of money. They use this pool of money to go ahead and buy more real estate. Investing in REITs makes it possible for investors to participate in dividends without having to buy their own real estate. Now, I haven't personally invested in REITs, but after seeing that the average returns are hovering around 10.5%, I might seriously consider looking into it. Here are a list of some of the top REITs in 2020. Now again, I haven't researched these REITs individually, so I would highly recommend doing your own research prior to investing in them. And that's it. I've just covered some of the most popular investment vehicles that you can use in order to build your multi-million-dollar portfolios. I hope you enjoyed. Please subscribe to my YouTube channel if you haven't already to join the Millipreneur community, and leave a like on this video. Turn on notifications so you're alerted every time I post a new one, and feel free to follow me on my Instagram at Eric_Anthony_Lopez. Also, I recently got a new URL on my website, so feel free to check it out at themillipreneur.com. Thanks again for watching, and see you on the next video.